So let's do a Lucia Capital Group Weekly video. I'm Rick Plum. As you get closer to or into your required minimum distributions, you may find that the requirement to remove a percentage of your funds from your tax-deferred retirement accounts is a bit of a tax burden. Now, of course, if you need those funds to pay your monthly expenses, there's not much you can do except bite the bullet and pay the taxes owed. But if you don't need the money, and you're only removing the funds because the government requires you to do so, it's really nothing more than an unnecessary added tax to you. Now, this is where something called the Qualified Charitable Distribution, or QCD, may be able to help. The only requirements here are that you don't need the IRA distributions to fund your living expenses, and you plan on giving money to a qualified public charity sometime during the year anyway. The strategy works like this. Once you're at least 70 and a half, you decide how much money you'd like to give your qualified charity or charities, and then you instruct your IRA custodian to transfer that amount of money, or some portion of it, directly from the IRA to the charity, bypassing you in the process completely. By doing it this way, that amount will not appear on your tax return as a taxable event to you. The amount you give can be any amount you want, up to a combined $100,000 for the entire tax year. And that amount will count towards satisfying your required minimum distribution. The combined result is that by sending the money via a QCD directly from your IRA, your charity gets the money, and it counts towards your IRA required minimum distribution, and it's not part of your taxable income for that year. That's not a bad deal, is it? Now, what if you didn't do the QCD? You took the RMD for yourself as normal, and then you just turned around and wrote a personal check to the charity. Now, logic would dictate that the RMD is taxable coming into you, and then the check to the charity is potentially deductible going out. So the two of them just cancel each other out. But logic and tax law don't always go together. What really happens is that when you take the RMD for yourself and add it to your tax return, as you would normally do, that income is what's called above the line, meaning it adds to your adjusted gross income for the tax year. If you can itemize, and most people cannot anymore, that deduction happens further down your tax return below the AGI line. So now your adjusted gross income has gone up, thus potentially increasing the taxability of your Social Security. It can also increase your Medicare premiums, and as well as your Medicare surtax on capital gains and other investment income. It may also phase out some of your itemized deductions, among other things. So doing it in the non-QCD way creates a kind of ripple effect across your tax return, and not in a good way. By doing a qualified charitable distribution, your AGI does not increase by the IRA distribution sent to the charity, thus potentially avoiding these issues that I mentioned a moment ago. And here's a bonus. If you don't itemize, and thus can't deduct your charitable contribution, by doing a QCD, you get what amounts to a de facto deduction. I take that deal any day. Now, a few rules for doing a QCD. First, the IRA owner must be at least age 70 and a half to do this. And second, there's a $100,000 per year donation limit through a QCD per taxpayer. So a married couple could each do up to $100,000 each if the distribution comes from his or her respective IRA. And third, this works only for traditional IRAs and not from any kind of employer-sponsored retirement plan like a 401k. Now, one key issue to watch out for. The 1099-R that you receive will not list the QCD as a separate distribution. It's just part of the total distribution that was sent from your IRA. And since there's no code, your tax preparer won't know about it, and they'll just list it as part of your normal taxable distribution. So make sure you tell your tax preparer that you did the QCD. One final thing here, which is a change from the last time I mentioned this topic a couple of years ago. If you've made any contributions to your IRA post age 70 and a half, which we can do now thanks to the Secure Act, those contributions have to come out first. They cannot be turned around and be used as a QCD. So the rules effectively require a LIFO, last in, first out, treatment that ensures the post-age 70 and a half contributions will first and foremost be used to reduce future QCDs. But hey, that's a minor blip. A QCD can still make sense for anybody who's charitably inclined and who doesn't need their RMD to fund their living expenses. If you want to know whether you may benefit from the QCD strategy, the advisors here at Lucia Capital Group do this kind of thing every single day. Just give us a call. We're here to help.